So I found a Market Watch article, and it said the number one enemy of your 401k may be you.
Maybe.
It talks about everyday people that are pushing money into the market when they see the market go up, and then they don't know what to do when the market goes down. And most of us have some kind of a proportion on our 401ks or our investments. It's 60-40, it's 50-50, it's 80-20, whatever it is. And it says, and this is the quote, the superpower of your portfolio is the fixed portion. So 60% in stocks, 40% in bonds or wherever, and it's protected and it's out of the market. They say that 40 number, that's the number that really saves you. So let me ask you about that. 60-40 is very common. When people come in, are they aware of these proportions? Do you have a proportion that you like to use for people? How does it work with that? And is that fixed portion the most important thing of that portfolio?
Yeah, most people are aware of this concept of, hey, kind of what's my allocation here, right?
Okay.
50-50, 70-30, what kind of the different things that you mentioned, right? But it's typically at a high level like that, and they don't really understand what role is each different part here supposed to play, right?
Okay.
The only caveat I'd mention with what's being said here is, hey, your fixed portion is a superpower. It depends on what the markets are doing.
Yeah,
if the markets are going up, it's not the superpower. It's actually dragging you down, right?
Okay.
And it's not that easy. We've talked before about you, me, nobody else. We don't know the day the market's going to bottom. We don't know the day it's going to top, right? So trying to manipulate that and time the market is kind of a fool's errand at that stage, really. It more comes down to what stage you are in your life, right? The vast majority of our clients are, late 50s, early 60s. That's true. We'll have some young people that come and see us occasionally, right? Usually it's children of our clients that we'll put some time for and give them kind of a complimentary consultation because they're the child of one of our clients. And they're in their late 20s, they're in their early 30s, whatever it may be. And we'll have a discussion with them and try and encourage them to say, hey, look, sorry to tell you this, man. You got 30 or 40 years left that you're going to be working. You're not retiring like your parents are anytime soon.
Right.
And the best thing you can do for yourself right now is be as aggressive as possible with your investments because you've got time on your side, right? You've got this long runway where is another downturn in the economy or the market's going to happen? I can just about guarantee it. It's going to, right? Is it a deal breaker for you? Well, this is money you shouldn't be touching till you retire. So keep going, right? We'll try and have a discussion. The point I think this is trying to make is that you have to pivot at some point, right? You have to pivot away from that kind of young mind mentality of like, I'm going to retire decades from now and it's just about accumulation and growth right now to, wait a second, there's a point to everything that I've been saving and I want to use that to fund my retirement. It's not that you shouldn't have any sort of risk in your portfolio at that point, but you probably can't take as much, right? You probably need to step that risk down a little bit because hopefully you're going to have a nice long retirement. Maybe you're going to be retired for 20 to 30 years. So we do need some growth, but we're tapping this thing as well, right? We want to get access to this. We need some money out of this. Yeah, we're going to have our Social Security, but probably we need to supplement that. And we need something that's going to be reliable and stable, maybe even income generating, depending on what you're investing in, to help us through our retirement.
Gotcha. So now when we talk about these proportions, maybe that 30, 40-year-old person that you have is 100% in the market. They just push it all in. Maybe they're a little more conservative and do 70-30. Well, if you get into retirement and you say, okay, how about flip that? 30-70, 30% in the market and 70% protected. That way, if the market goes down 50%, I'm not down 50%. I'm down 15%. And I can probably come back from that over a period of time. So it seems only prudent and it seems smart to say a little less in that up and down and all that risk and a little more toward developing income is really what I want to talk about. I got to believe that that's a main part of the discussion for people in their 60s.
Yeah, we definitely spend a lot of time on that. And to take it one step further, it really depends what's happening in that individual situation. Okay, everybody we have come in here, there's something a little bit different going on in their lives. Some people are going to be drawing from those investment accounts, those 401ks, those 403bs, 457s, whatever them IRAs, whatever they might be. They're going to be drawing on them fairly substantially to help supplement maybe Social Security because of what they want to do in retirement. We have some people that come in here that, yes, they're getting Social Security. They've got some nice big pensions too.
Okay.
And they're just like, hey, look, between our pension and our Social Security, we're really comfortable. And we are not going to draw from our accounts. We're not really planning to do that. We're almost kind of back in our working years, investment philosophy wise, because we've got time, right? We don't have to constantly be drawing income from this portfolio. So we want to get more aggressive. So we never, when someone comes in, we say, all right, you have to be 50-50, you have to be 60-40, whatever it might be, because we don't know what's going on with them yet. Right?
Yeah.
Once we know that, we can start to go through the process together with them to come up with that recommendation. But anybody who's been given a recommendation of a specific allocation or split like a 60-40, before you've really gotten into the weeds on what does the financial planning look like, where are the income sources being met from, they're not giving you the correct advice.